Overnight, Israel launched airstrikes on Iran's nuclear and military facilities, and oil markets reacted instantaneously. The entire forward curve just spiked, with the front end contracts surging the most. We're now back to price levels we haven't seen in months. So, what's really happening? What comes next? And how do you position without panic? Let's break it down. So, we were talking about this over the last couple of weeks. I want to quickly talk about what drove this squeeze, what accelerated this. It wasn't just that traders feel now that oil is going to be moving higher, but there was a legitimate repositioning in the futures markets. Now, this comes from CTA positioning. I have here a chart from Goldman Sachs showing where CTAs were positioned, and they are trend following, and they're both willing to be short and long with billions of dollars of exposure. Going into this short squeeze that we saw here, whether on the short-term trend, medium-term trend, or long-term trend, they were net short, and a net short to the tune of close to $8 billion. And so when we're looking at the path from which their position would be, is that there was very little chance that they were going to get any more short than they were already. This kind of gave the floor of where oil was going to be, largely because that additional selling that would typically come from CTA flows, it was simply not there. But as we saw and witnessed here, when the triggers on the upside, which were around the $64 and $71 areas, got triggered, it created close to $10 to $15 billion of buy flows just from trend following strategies. And this fuel just accelerated oil higher from here. All right, let's take a look at this chart. We had an intraday $10 rise in crude oil from $68 to $78 before giving some back, trading around $73 on the front month contract. So Israel overnight had airstrikes on Iranian nuclear military facilities that sent shockwaves through these global markets, bracing for potential supply disruptions. What does it mean? Is the move over? Did you miss it, or is this the beginning? Well, right now, it's clearly as a short-term opportunity, the short squeeze that we were talking about on this YouTube channel just a few weeks ago, setting up the opportunity at 62. That move on the short term is over. The bigger question, though, is does this create a new buying opportunity for a new longer-term trend? Have we seen the entire energy markets pivoting? Are we seeing that the Middle East is now going to be a hot mess for a while, and that somehow these disruptions will spur new incentives to get shale oil working again, and to see the global energy markets start diversifying away from all their dependence on the Middle East? That requires higher oil prices. So one of the things that we'll be watching is that once this on the very short term stabilizes, do prices stay up in the 70s on a sustained basis? So if we've turned around and see oil prices hovering up at these levels for a week, 2 weeks in the consolidation, there's no reason why we can't see $80+ crude oil. And if the escalation really got into a full-on hot war, we could end up where this is going to see the straits shut down for oil. We could see a scenario where we could even, if I put this on a weekly chart, go up to the $90 area, and we could end up seeing crude oil trading up along these kind of levels on the upside. But that would be something that would develop over weeks and months and not necessarily get there all in one go. On the short term, this is a very challenging place to do a brand new buy. Like at this stage, if you start buying today, it's sort of like just chasing like a FOMO of wanting to get in because there's action. Overall, there's not much asymmetry on the short term, but the question is, what am I going to do about it? Well, really at this stage, I'm taking a little bit of profits on the trades that I have on, doing a little bit of hedging, but for me, it's all going to be about setting up for a potential pivot in the energy markets. Now, I want to observe here the chart on the XLE, which is the broader energy ETF. Now, if one can see here that virtually for the last 6-7 months, there's been a pretty distinct bear market, including a very slow recovery off of the April lows in these energy stocks. This morning, we have this gap higher now starting a new trend. The thing that we're going to watch now is, will new money flow start to come into these energy stocks? And my answer to that is yes. I think we're going to see this develop into a nice, clean, new trend. We want to buy dips. You want to be careful about which ones you're picking and why you're picking them. But there's plenty of room for these energy markets to rally all the way back to their year highs the way the rest of the stock market did. In that situation, there's at least a solid 10% upside on these energy stocks in the coming months. It's an opportunity I think everyone should be taking advantage of.